Good morning, traders and investors. My name is Roger Scott. Today is Thursday. It is the 14th of January. It's the Thursday, the second week of the new year. And this is the real week that funds come back into the market. They're a little slow to come back. First week is a slow, volatile week. We got low liquidity. You've got big fat fund managers. When I say big fat, I mean they have a lot of money. They like to take extended vacations and they like to come in slowly. But the second week of the year, which is where we're at right now, does set some tone and give us some good clues and indications of what we can expect going forward over the next few months. Now, right now, pre-open, market's going to open up in about an hour. I wanted to show you what's going on right now. NASDAQ was down. It's just now going a little higher, but NASDAQ 100 is weak, and that happens to be the most vulnerable index right now. So this is the level of vulnerability. You got the NASDAQ 100, then you have the S&P 500 as far as vulnerability. Then you have the Dow, then you have the mid caps, and then you have the Russell 2000. So from a position of strength, it's the opposite. Russell is the strongest, then you've got the mid caps, then you got the Dow Jones, then you have the S&P, and the worst is the NASDAQ 100. That's what's been the most overbought. It has grossly overbought. Now, I wanted to wait till about 8:30 to do this report because guess what happens at 8:30? The prince turns into a pumpkin. I'm just kidding. At 8:30 in the morning, jobless claims come out. And I wanted to wait to make sure these numbers came out so that I can include them in my analysis. And boy, oh boy, this is bad. Folks, this is as bad could be, and this is confirming that the new COVID-19 period that we're seeing right now, this new second wave of infections, is in fact having an impact on the jobless market, or the jobless market. It's making it a jobless market. Sorry, I'm trying to be as unfiltered as possible. It's an hour before the opening bell. It's still kind of early here. But yeah, here's the point. This is 965,000 new claims for the week, okay? This means the number of unemployment is going up. More people are unemployed. If you look at the 4-week average, it's about 816,000. The consensus was 790,000. Almost 200, 130, 181,000 more. Why do I need to calculate? I got it right here in front of me than expected. The point is, this is bad. This is telling us that the impact of the vaccine is not having an influence on the job market as we hoped, and this is what I was afraid of. Remember the example I gave you? I said here we have the madman, and here we have James Bond running to save the day. The madman has his button on the hand on the button that destroys the world, that the missiles launch, and here James Bond comes, and it's what happens first? Does he save the day, or do we launch the nuclears, right? That's kind of the scenario we're at, because if we can't get COVID vaccine under control, and this is telling me right here that we are nowhere near under control. This is going back to the levels that we saw in March, April, May of last year, of 2020. This is bad. This is telling us that healthy people are not getting vaccinated right now. Otherwise, the unemployment rate would be going lower, not higher. Or it's telling us that people are not hiring right now because of COVID. Either way you look at it, this is related to COVID, and this is bad. Now, in terms of the stock market, then I'm expecting the market to cool off a little bit based on this news. Although we are expecting something from Biden that's going to give us his plan on how he's going to deal with his plans moving forward, the stimuli numbers. So that may be holding the market up temporarily. But I'm going to tell you right now, folks, fundamentally, this is very bad. We've had 2 or 3 of these numbers. We've had 2 or 3 of these spikes already. And if we go above 1 million, it's bad. It's bad. And it reflects very negatively on consumer sentiment, which is the report that comes out tomorrow, on retail sales, which comes out tomorrow, on industrial production, which comes out tomorrow. So again, I'm not expecting retail sales or consumer sentiment or industrial production to be really great, especially in light of this report. 965,000 claims, jobless claims for the week. That's terrible. And this is fairly recent. This is released on 14th for the week 1/9 for last week. This is telling us that people are not working right now. Now, if you look at interest rates, this is the long-term bond. This is a long-term triangle, and you can see here we broke down, but it looks like we're going back up. I honestly don't think interest rates are going to be going higher right now. Remember, the long bond has an inverse relationship with interest rates. So interest rates go higher, bonds go lower. Interest rates stay subdued, bonds go up or stay subdued. I honestly think this was a false breakout. I think it got a couple of, it shook out some weak hands. But I honestly do not think interest rates are going to be going higher for the foreseeable future. And even the expectations of interest rates going higher in the foreseeable future are not going to be that strong. So I believe the bond market is going to go back to its base unless Biden starts giving us some data that's completely unforeseeable in terms of markets expectations right now. Now, in terms of global economy, just to give you an idea of what's going on, stocks advanced Thursday as people are waiting for his plan, Biden's plan to see what he's going to do to help the U.S. economy recover from the COVID-19. And folks, we need it bad right now. We need it bad. House of Representatives voted to impeach President Trump on the charge of incitement of insurrection. I'm going to just stay away from that. Investors have been looking past political turmoil and focused instead on the expectations for stronger economy ahead. Yeah, but with this number right here, whew, that's not good. But again, we're going to hear later today on how he plans to support the economy, and I'm hoping that it's going to be really bullish news. Markets got a boost from China. China is coming out of this ahead of us. It reports that its exports rose in 2020 despite pressure from COVID and tariffs, which I don't think we're going to see a lot of these tariffs with Biden taking office. Exports increased, and an improvement from previous years, 0.5% gain. That's great, 3.6% from 0.5%. Imports edged down 1.1%, but growth was strong in the second half after China became the first major economy to revive following the pandemic. Do you guys remember what they were doing? They were throwing bleach at night. I mean, they were just doing crazy things. But I could tell they're not lying. Why? Because if you go to Amazon, you will see tech parts, you will see cameras, tech equipment, computer equipment where parts are made in China. They're available now. March, April, May of last year, they were not. Nearly a year after the pandemic, China has put more than 20 million people under varying degrees of lockdown. Not sure if America is following the same steps. World markets have rushed higher recently in anticipation that economies will recover with the rollout of the vaccines and more stimulus. Folks, but for hopes of stimulus and new vaccine, we are right now in a bad place. So the economy is running right now on hopes. If those hopes turn to reality, and I'm hoping they won't because the market always discounts everything ahead of time, we're due for some downtime, some bearish signs. Let's just say that. And I want to show you something again, something to keep your mind attention on. This is the QQQ, and I know it's going higher and everybody's excited, but look at the divergence. Momentum levels, highs are going lower. I know I show this all the time, but it's going to come and bite you in the butt. Higher highs in price, lower highs in momentum. That means the NASDAQ 100 and the S&P are diverging. That means momentum levels can't sustain the type of upside momentum that the market is seeing. And that's very, very negative. See, lower highs. See the high here? Can't go to this level, but the price has. Let me just refresh this. It just keeps winding and winding. And typically after these large wind-ups, the market cools off. And I'm expecting any day now, literally any day now, for the NASDAQ to cool off and hit the 50-day line or possibly go into the twilight zone, which is the area between the 50-day and the 200-day, which will cause the market to cool off and not become so overbought and diverging. And momentum levels, which are at an 11-year high, as I've shown you many times, and I'll show you again so you could see what I'm talking about. Look at the number of stocks in the NASDAQ. You got to see this. I'm going to go to 20 years. Look at this. Look at that. Look where we're at right now. 90% of stocks are trading above the 200-day moving average in the NASDAQ 100. That's the highest level we've seen since right here, December of 2009. So divergence, momentum levels, the markets are vulnerable right now. They're still moving higher. They're hoping that we're going to get somewhere. But reality is jobless claims. And if tomorrow's retail sales numbers are negative, and it looks like they will be because jobless claims aren't picking up, retail sales has not been really strong aside from e-commerce, I'm very nervous about what we will see over the next few weeks. Now, in light of that, I still have 3 stocks that are showing no signs of slowing down. All 3 are making 90-day breakouts, and I want to go through them with you. AppView, just to show you this stock, to show you how strong it is. Let me go back to, look at that, nice rounded bottom, higher highs, volatility levels staying the same. This is very, very good sign. And if you look at the stock long term, it's breaking out, and it's right now making a highest high since 2018, and I like this stock right now. And you will notice that the stock is a biotech large pharmaceutical healthcare stock, and Biden is expecting to put a lot of money into healthcare, and hopefully this is one of the companies that benefits from it. Another stock that's breaking out, finally, folks, people are starting to look past COVID. I know it doesn't make a lot of sense right now, but they are, and we can't argue with that. The stock has been congesting sideways for good amount of time. What do I always say? Sideways, up or down. Horizontal, vertical, horizontal, vertical, horizontal, vertical. Look at the nice congestion, and now it's breaking out to the upside. I like Uber because, again, the markets are anticipating. The markets are always running 3 to 5 months ahead of time. They're always pricing in everything that's known. And with COVID around the corner, with that carrot being dangled, people are starting to see Uber and other companies that are focused on people going out and doing stuff becoming more profitable once again. The stock has been congesting for quite some time. Finally, it started breaking out right at the end of October, right when Biden started taking the lead and when we started hearing more positive news about COVID environment. And the last stock, this is PayPal. PayPal should continue going up no matter what, stay at home or not, because online retail, everybody using online systems, a lot of people are using PayPal. I like the fact that volatility is not increasing. If you look long term, the stock has been moving horizontal, vertical, and right now it looks like it's making another leg up. And I think PayPal will go up regardless of which environment we're in. Why? Well, if people are locked down, they're going to be putting more strain on e-commerce and buying stuff online. And when people buy stuff online, guess who gets paid? PayPal. They're one of the biggest payment processors in the world. And if people go back out, that means the economy expands and people buy more consumer discretionary items, and PayPal makes money. So any way you look at it, PayPal should be profiting, especially if economy picks up, because when the economy picks up, people spend more money. So I like AppView, I like Uber, and I like PayPal right now. Now, folks, if you're sick and tired of looking at stock charts all day just to pick through Wall Street crumbs, who wants Wall Street's crumbs? Then you've come to the right place. Forbes contributor Adam Sarhan, he's finally revealing how you could spot today's most explosive stock market opportunities before most Wall Street elites are wise to them. Get on the best stocks before Wall Street comes pushing them higher. And the best part is you won't have to make risky bets or get special brokerage permission to do so. You're just buying straight up stocks or selling stocks or buying calls and puts. No complex spreads, no combinations, no fancy large accounts, none of that stuff. Simple and easy and clean. I mean really simple and clean. To learn more about Adam's little known alpha trades and how they can transform your trading account, follow the link below. Get in on this now. And post me some feedback. I love to hear from you guys. You can always send me an email, support@marketgeeks.com, or you can post below this video. Check out Adam's little known alpha trades and how they can transform your trading account. Follow the link below, and I'll talk to you guys tomorrow. Bye, everyone.